Okay, so we're going to continue our discussion of the new Keynesian model today. What I'd like to do kind of at the top of class is give you guys the opportunity to work another practice problem um, to kind of test or review your understanding of kind of the main mechanisms behind the new Keynesian model. So if you're able to analyze it graphically and then kind of work through the logic of how the output gap and inflation are stabilized within the model, using those kind of same arguments that we talked about in the last class. And then what I want to do is talk today a bit more about this thing called the Taylor principle, and in particular, what happens when new Keynesian models violate the Taylor principle, which hopefully you guys recall is this condition on beta pi, which was that coefficient in the monetary policy rule that governs how aggressively the central bank adjusts its policy interest rate to changes in inflation. We have assumed up to this point that beta pi was bigger than 1. What happens if we relax that assumption? Well, it turns out everything goes haywire in the new Keynesian model, and so I want to show you guys that, and then actually show you some data on episodes in history where that likely actually occurred in practice. Okay, so let's go ahead and start with one of these. I don't think we had time to do this one in the last class. So this is this solve problem 7.3. I want you guys to analyze a decrease in expected inflation in the context of this 3-equation new Keynesian model. Okay, so consider the effects of a sudden reduction in expected inflation. We don't know why it's occurring, but investors and private sector households suddenly think that the economy's rate of inflation is going to fall. Okay, I want you guys to do 2 things. Illustrate graphically the short-run consequences of lower expected inflation using the ISMP Phillips Curve framework. That is the new Keynesian model. And make sure you identify all the curves correctly and identify the direction that the relevant curves are shifting, and that you label the reference points on your graph. So where is the initial equilibrium? Where is the terminal equilibrium? Okay, so that's the first step, is to analyze basically the business cycle consequences of this sudden reduction in expected inflation. All right. The maybe more challenging thing to do then is to use your ISMP and Phillips curve equations to provide a clear argument for why inflation and the output gap adjust by the amounts that you illustrated in your graph. In particular, does the output gap change by the full size of the shift in whatever curve you've identified? Does inflation change by the full size of the shift in whatever curve you've identified? Or, as you might guess, are the output gap and inflation at least partially stabilized in response to a sudden decrease in expected inflation? I want you guys to work through the logic of the model or the transmission mechanism like we did in the last class. How is inflation affected by the shock? How does that affect the nominal interest rate? How does that in turn affect the real interest rate? How does that in turn affect the output gap through the IS equation? How does that feed back into the Phillips curve? Okay, there's 2 parts to this type of problem. Let me give you guys a few minutes to get a head start, and then we'll go over the answer together. Hopefully one of you all will be able to provide a good detailed answer for me. You guys need another minute or two, or does somebody want to venture a guess here for me? So here is a sketch of the economy in kind of its initial equilibrium point, right? We have a Phillips curve. Inflation is equal to expected inflation plus kappa times the output gap plus a supply shock. And we have our ISMP equation. Now, where does that come from? That comes from taking the IS equation and the monetary policy rule and inserting them one into the other and deriving a second equation that expresses inflation as a function of the output gap, but also of target inflation and the demand shock. All of that we covered in the last class or so, okay? The Phillips curve is this upward sloping relationship between the output gap and inflation. The ISMP curve, as we've constructed it so far, is this downward sloping relationship between the output gap and inflation. Remember that we also need these parenthetical arguments here because we have to recognize that the Phillips curve depends on expected inflation and the supply shock, whereas the ISMP schedule depends on target inflation and the demand shock, okay? So here is my initial equilibrium point where the output gap is 0 and actual inflation is equal to, let's just say, pi 1. And pi 1 happens to also equal what expected inflation is equal to, as well as the target rate of inflation, okay? Now, who can help me illustrate graphically what happens if there is a sudden decrease in expected inflation? Is that going to affect the Phillips curve or the ISMP curve directly? The Phillips curve. And what direction is the Phillips curve going to shift? It should shift to the right or down, right, by the size of the reduction in expected inflation, okay? So be careful about how you graph this. I want you guys to get the reference points right, okay? So notice that the Phillips curve is shifting down, and by how much does it shift down? Well, let's say, what's your name on the back row again? Doug? Let's say that expected inflation falls from pi 1 to some new pi 2. It's just a low 2% to 1%, let's say, okay? Then how much is the Phillips curve going to shift down by? Well, it's going to shift down by the distance between pi 1 and pi 2, right? Given a 0 output gap and no supply shock, right, actual inflation will fall from pi 1 down to pi 2. So the whole curve shifts down vertically by that amount. So pi 1 minus pi 2, you can think of as the size of the disturbance here, okay? Now, Doug, is that, you said your name was? Say again? Devin, sorry, I can't hear very well, and the masks are muffling. What happens in equilibrium? So the Phillips curve shifts down vertically, but this is not the point that the economy ends up over the course of the business cycle, right? The economy ends up over here at the intersection of the new Phillips curve and the same old ISMP schedule, right? And that is a point at which inflation is lower than it was originally, but not as low as the full shock to expected inflation. Moreover, the output gap increases, but it doesn't increase by the full amount of the shift in the Phillips curve, or the rightward shift in the Phillips curve in this case. So what we see here is that actual inflation and the output gap are more or less partially stabilized in response to this sudden change in expected inflation. That's part one of the problem, all right? And perhaps it's the most important, the one that I want you to be able to analyze graphically what happens in equilibrium here, okay? So this shock should lead to falling prices and inflation and rising levels of output over potential. But you'll notice again that there's this kind of partial stabilization built into the model. Now, why is that? Let's go through. So this answers part 2, or part B of the question. Use the ISMP Phillips curve equations in order to better understand why inflation and the output gap change by the amount that they do. Anybody want to help me walk through this explanation? If you can do this, then I think you've really mastered an understanding of the transmission mechanism that is embedded into the new Keynesian model. Well, what's the thing that we start with? There is a reduction in expected inflation, right? So pi e falls from, let's say, pi 1 to pi 2, okay? That is going to lower actual inflation through the Phillips curve by pi 1 minus pi 2, like we said a minute ago. So immediately there's going to be downward pressure on the actual rate of inflation, okay? Well, there's going to be a policy response to that, correct? How will the central bank respond to this inflation development? If inflation is falling, what is the central bank going to do? Don't think about it. Look at the equations of the model. Look at the monetary policy rule. That's going to help discipline the way you think about these problems. If inflation falls by pi 1 minus pi 2, what's going to happen to the nominal interest rate or the policy rate in this problem? Levi? It's going to decrease, right? And how much is it going to decrease by? By beta pi times the change in inflation. Go back and look at the Taylor rule, and you can see immediately that if inflation drops by some amount, pi 1 minus pi 2 in this problem, the nominal interest rate drops by beta pi times that amount. Okay, Levi? If the policy rate falls by this quantity, what happens to the real interest rate? That's the interest rate that matters for the transmission mechanism in the model. What happens to I minus pi, the real interest rate? Or anybody? Well, if pi falls by 1% and the nominal interest rate falls by 1%, then what happens to the real interest rate? Nothing, right? But if the nominal interest rate falls by more than inflation, then the real interest rate declines. If the nominal interest rate falls, but not by as much as the fall in inflation, the real interest rate increases, okay? So here we know that the real interest rate, the nominal rate minus inflation, has to go down. And why do we know that? Because beta pi is bigger than 1. The nominal policy rate is responding more than 1-to-1 to the change in inflation, right? So the real interest rate falls by beta pi minus 1 times the change in inflation. Okay, that's the critical part. Because if we know that the real interest rate is declining, then what happens to the output gap in the IS equation? It's going to go up by the change in the real interest rate, right? Remember, the output gap and the real interest rate are negatively related to one another in the IS equation. And if the output gap rises by beta pi minus 1 times the shock to inflation, then what happens to inflation? In the Phillips curve, inflation is going to rise by kappa times however much the output gap goes up by. So you see what is happening here is that the reduction in expected inflation immediately puts downward pressure on inflation. However, because the central bank tries to stabilize inflation in response to this shock, it lowers the real interest rate enough to raise the output gap to try to bring inflation back up somewhat, right? So inflation goes down, but it also goes back up a little bit because of the stabilization efforts of the central bank. And so in the end, then, the net effect is that inflation does not fall by the full amount of the shock, but rather only partially. The central bank is at least partially stabilizing the economy in response to this shock to expected inflation. And because it lowers the real interest rate to do that, it boosts the output gap somewhat. Further illustrating this trade-off between inflation and output gap stability, right? Presumably, the Fed could try to fully stabilize inflation by lowering the real interest rate a whole lot, but what would that create in return? A much bigger output gap. So you end up with output being way above potential in order to fully stabilize inflation. There's this trade-off between trying to stabilize inflation versus the output gap, right? And the new Keynesian model illustrates that trade-off pretty well. Okay, you guys have any questions then about that one? So you will have another opportunity to practice this on your lab. I'm going to give you at least a question or two. There's basically two parts to these types of problems, okay? Is to be able to analyze graphically what is going on, where you label the curves appropriately, as well as all of these reference points, but then to try to understand why inflation and the output gap change in the amount that they do in equilibrium. You need to be able to go through these types of arguments where you show how the change elicits a response from monetary policy, which therefore changes the real interest rate, which therefore feeds back into the IS equation and affects the output gap, which will then affect inflation in the Phillips curve, right? Being able to work through the transmission mechanism logically by analyzing the equations is the second part of these types of problems. Okay, you guys have any questions then about that? If I have time today, I will come back and do one more example of these from a problem that is not in the slides. But I want to at least get to the next part to make sure I can get through it today. Are we good? Okay. Let me move on now and talk about a slightly new topic, and that is this thing called the Taylor principle. So this is the fourth section of this part of the slides. There will be 5 in total. Okay, up to this point in our coverage of the new Keynesian model, we have imposed the following constraint on the monetary policy rule. So here is our modified Taylor rule. This is the MP equation in our new Keynesian model, which says that the policy rate, I, is the equilibrium real interest rate plus target inflation plus beta pi times the inflation gap. Up till now, we have consistently just assumed that beta pi was bigger than 1, okay? Now, what this means in practice, of course, is that the central bank adjusts its nominal policy rate aggressively in response to deviations of inflation from target. That's what that means in practice. That's how we interpret a beta pi bigger than 1. Let's say 1.5 or 2, okay? So aggressively, in fact, that movements in the policy rate, I, the nominal interest rate, will generate movements in the real interest rate in the same direction, okay? That's an important point. So this assumption that beta pi is bigger than 1 means that anytime the central bank is adjusting the nominal rate in response to a change in inflation, it will induce a change in the real interest rate in the same direction as the change in the nominal interest rate, okay? Again, let's just work through the arithmetic to make this as clear as possible. Let's suppose, Margot, that inflation jumps by 1%, okay? That means, according to the Taylor rule here, the nominal interest rate is going to be elevated by the central bank, by the Fed here, by beta pi percent times 1%, right? Okay. What does that mean is going to happen then to the real interest rate? The real interest rate is the nominal rate minus inflation. If inflation rises by 1%, that causes the real interest rate to decline by 1%. But if the nominal rate rises by beta pi percent, that causes the real rate to rise by beta pi percent. What is the net effect? Beta pi minus 1%. If beta pi, Margot, is bigger than 1, we know that the real interest rate will go up if the Fed raises the nominal interest rate. If beta pi is less than 1, then the real interest rate is going to go down anytime the nominal rate rises as a result of rising inflation. Okay, that's what we've assumed thus far, is that beta pi is bigger than 1. Now, what this restriction implies for the equations of our new Keynesian model is that the ISMP curve, and if you put the monetary policy rule inside of the IS equation and solve it for inflation, you get this equation, right? What it implies is that the slope of the ISMP curve is going to be negative. If beta pi is a number bigger than 1, then this coefficient that is multiplying the output gap has to be a negative number. It's a negative times a 1 over beta pi minus 1. Beta pi minus 1, therefore, being a positive number. So the whole coefficient has to be negative. So this restriction on beta pi means that the ISMP curve is going to be negatively sloped. The idea that monetary policy rules should have this feature is known as the Taylor principle, okay? And it was a principle that was, of course, popularized or first developed or first articulated, perhaps I should say, by the same guy that came up with this monetary policy rule, John Taylor. All right, John Taylor's policy rule satisfies the so-called Taylor principle. This idea that the nominal rate should move more than 1 for 1 to changes in the rate of inflation. Okay, now here's what I want to think about for the bulk of the rest of the class today. What I want to do now is consider what happens in our new Keynesian model to the economy or to macroeconomic stability in general if the central bank implements a policy rule that fails to satisfy the Taylor principle. What if the Fed implements a policy rule but beta pi is equal to 0.9 instead of 1.1? What kind of outcomes might emerge in theory? And can that help us explain some of the bad outcomes that we saw regarding inflation at certain periods in our history? Okay, so we're going to confront this model directly to the data here in a few moments. What are the implications for macro stability? That is, for inflation and output gap stability. In other words, does the Fed find it more difficult then to accomplish or satisfy the dual mandate, right? Price stability and full employment or output. Okay, well, let's think about that in the context of the model. Okay, so again, here is our Phillips curve equation. I'll usually just tell you what that is, even though hopefully you will eventually put it to memory after you've seen it enough times. And here is our ISMP equation, okay? The size of beta pi, you'll notice, does not affect the Phillips curve at all, right? You're still going to have this nice upward sloping Phillips curve for given amounts of expected inflation and the supply shock, okay? However, if beta pi ends up being less than 1, then you'll notice here that the ISMP curve ends up having a positive slope, right? A -1 divided by, let's say, a 0.9 minus 1 is a positive number. It would be positive 10 in this case, right? Think about what happens here. If beta pi is bigger than 1, but it's approaching 1 from the top, then the ISMP curve is getting steeper and steeper and steeper, but it's still negative, right? When beta pi is exactly equal to 1, what happens to the slope of this line, the ISMP curve? You get a 1 divided by 0, which approaches infinity. So the slope of the ISMP curve basically becomes vertical when beta pi is equal to 1. Once beta pi gets a slightly less than 1, then the slope becomes positive, but very, very steep. So the way I've graphed it here would be like for a value of beta pi that's just a little bit under 1 in this case, let's say 0.9, something like that. Again, the ISMP curve assumes a given value for target inflation and a given value for the demand shock. The intersection of these two curves tells us what the equilibrium level of the output gap and inflation are going to be. And so here's my same old initial point. We're going to assume that at the output gap of 0, inflation is equal to pi 1, which is equal to expected inflation and also target inflation. Okay? But now the ISMP curve has this weird upward slope to it. All right. I want you guys to tell me, let's re-examine one of the cases that we considered in the last class. What happens if there is an inflationary supply shock, in the sense that there is this adverse shock to the Phillips curve that is a positive value of epsilon? So you can think of this as an oil price shock or some other type of shock that affects the general price level in a negative way or in an adverse way. What happens to the ISMP curve versus the Phillips curve? Which one is going to be affected directly? The Phillips curve, right? And the Phillips curve is going to do what? It's going to shift up by exactly the size of the supply shock, right? This is what happened in the last class. We saw that an adverse supply shock shifts up the Phillips curve exactly by the size of the shock epsilon, right? So now at the same old output gap of 0, inflation rises from pi 1 to pi 1 plus epsilon. Now, what happened in the last class? The ISMP curve was downward sloping. And so in equilibrium, inflation goes up, but not by the full amount of the shock, right? And the output gap is negative. It falls, but not by the full amount of the shock. So an adverse supply shock generated some inflation, but then also a recession, as the Fed tried to stabilize inflation by raising the real interest rate to lower the output gap and therefore lower inflation, okay? What happens in a world in which the Taylor principle is violated? Instead of partially stabilizing inflation, what happens here? Actual inflation in equilibrium rises by more than the size of the supply shock. And instead of output falling, the output gap actually goes up. Okay? So the monetary policy reaction here, instead of stabilizing the supply shock, is now actually amplifying the effect of the supply shock on the economy by raising inflation more than the size of the shock. Now let's go through the steps of this logic to make sure we understand why this is happening, okay? The supply shock immediately occurs, and then through the Phillips curve, we see that raises the current rate of inflation by the size of the shock itself, okay? This change in inflation will elicit a policy response. How is the central bank going to respond to rising inflation? It's going to increase the nominal interest rate, right? And it's going to increase the nominal interest rate by beta pi times epsilon. But the question is, really what matters for this model is not what happens so much to the nominal rate, but what happens to the real interest rate, right? In this case, what's going to happen to the real interest rate as a result of this supply shock? Is it going to go up or go down? In the example from the last class, the Fed was able to orchestrate an increase in the real interest rate. What about in this example? Inflation goes up by epsilon, but the nominal interest rate only goes up by beta pi times epsilon, which is less than the change in inflation because beta pi is now less than 1. So beta pi minus 1 is going to be a negative number. So even though the Fed is raising its nominal policy rate, because it's not raising that rate aggressively enough, the real interest rate is going to fall. Now ask yourself, what happens to the output gap as a result of a lower real interest rate? In the IS equation, as the real interest rate falls, the output gap rises. People want to consume more today, invest more today, net exports go up, etc. Remember, the IS equation, there's a negative relationship between the real interest rate and the output gap. And so the output gap rises in response to this lower real interest rate. Unfortunately, what happens to inflation if the output gap starts to go up? We'll go back to the Phillips curve. Actual inflation is going to rise by kappa times the increase in the output gap. So monetary policy, instead of stabilizing inflation in response to the supply shock, is actually amplifying the effects on inflation because it's unable to engineer an increase in the real interest rate. Its weak or tepid response to the shock causes the real interest rate to go down, which increases the output gap, and that further increases inflation. So instead of inflation just rising by epsilon, it rises by more than epsilon because the central bank is violating this so-called Taylor principle. Does everybody kind of get that then? It's this, the way the central bank responds to changes in inflation in the new Keynesian model has a huge effect on how the economy responds to demand and supply shocks, okay? If the Fed satisfies the Taylor principle, then the economy is stabilized in response to shock. If it does not satisfy the Taylor principle, then these shocks can get amplified, leading to a great deal of macroeconomic instability. Let me continue on this theme. What if, so Jameson, you've just witnessed this happening in our economy. You've seen the Fed just not respond aggressively to this shock. You and I and every other investor in this economy is going to think that inflation is going to therefore be higher in the future because of this violation of the Taylor principle. And so what happens then is that our expectations of inflation are going to go up as a result of that. So Jameson, what happens then if we move forward from this equilibrium point? If expected inflation is higher, what might immediately come after this? Is there another shift in the curve that could occur? Well, let's think about this clearly now, right? Where does expected inflation show up in the model? In the Phillips curve. If you and I and everybody else suddenly think that expected inflation is no longer going to be pi 1, it's going to be something a lot higher, right? We expected pi 1. We ended up with pi 2, right? If we expect inflation then to be a lot higher, what happens to the Phillips curve? It's going to shift up, right? Now let's talk through this. If the Phillips curve shifts up because of higher expected inflation, then actual inflation is not going to rise just by the vertical shift in the Phillips curve. It's once again going to rise by more than that. Why? Because as inflation goes even higher, the Fed or the central bank here is going to raise the nominal rate, but they're not going to raise it enough to increase the real interest rate. The real interest rate instead is going to go down. And if the real interest rate goes down, what happens to the output gap? It goes up even more from here to here and then here to here. And as the output gap goes up even more, what happens to inflation in the Phillips curve? It goes up by, so there's a self-reinforcing mechanism here, which causes inflation to become even more unstable and causes the output, the level of output to be unhinged from potential output even more. And so you see here theoretically that when the central bank is unable to satisfy the Taylor principle, it can lead to a great deal of macroeconomic instability in response to shocks. And if our expectations adjust quickly because of that failure, the instability can be even greater, right? That's what the theory suggests. That's what the theory is telling us. What I would like to do now is, oh, I forgot, yeah, so I've already mentioned this, right? The real interest rate is going to fall again, raising the output gap and pushing inflation even higher, right? So to sum up here, the violations of these Taylor principle then can lead to these kind of unstable inflation dynamics. Now, why I think this example is so interesting is that I think it goes a long way towards explaining a particular time in US history that was really bad for the performance of inflation, okay? Let me show you a graph of a couple of data points here. So the blue line is the consumer price index measure of inflation in the US economy from 1960 through 2019. So I'm using just annual data here. The red line is a measure of the real interest rate, all right, which is constructed in Fred as the 3-month Treasury bill rate. That's the 3-month nominal interest rate minus the CPI measure of inflation. So the nominal rate minus the inflation rate. The rectangle here that I'm emphasizing is the late 60s through the 1970s. Now, you guys already know what inflation looked like during that time. It trended up, and it was highly unstable. There was a lot of inflation volatility. In the early 70s, inflation was, or the late 60s, I should say, inflation was 2.5% to 3%. By the end of the 70s, however, inflation was getting damn near close to 15%. So inflation was rising rapidly and was very volatile, okay? Now, can we explain why this happened by viewing the data through the lens of the new Keynesian model? I would argue that we can, right? What does the last slide tell us is a potential source for rising and unstable inflation if the Taylor principle is violated, correct? Well, take a look at the real interest rate. What do we know happens to the real interest rate when the Taylor principle is violated? Shocks like OPEC or oil price shocks in the 1970s, which cause inflation to go higher, if the Taylor principle is being violated, is not going to be followed by rising real interest rates, but rather falling real interest rates. You'll notice that during the 70s, real interest rate trended lower and became significantly negative. This is clear evidence that whatever the Fed was doing in the 1970s, it was not satisfying the Taylor principle. That whatever their value of beta pi was, it had to have been less than 1. The model tells us that that can lead to these episodes of rising and unstable inflation when the real interest rate does not respond aggressively enough to the rising inflation. Now look what happened towards the end of the decade in the early 80s. This provides even more proof. So Paul Volcker, recall, was nominated as Fed chair in late 1979. And in the years that immediately followed his appointment, what happened to the real interest rate? The real interest rate went way up. Why? Because Paul Volcker raised nominal policy rates to really high levels, like 15% or something, okay? And as the nominal rate went up enough to exceed inflation, the real interest rate went up. And what happened to inflation as a result of it? It came crashing down in the early 80s because as real interest rates are higher, that causes the output gap to go low and generate a big recession like we had in 81 and 83, and therefore causes inflation to fall through the Phillips curve. So just like the 70s shows what can happen when you violate the Taylor principle, the early 80s show how much more stable you can have inflation become if you satisfy the Taylor principle. You see, this is a beautiful example. I love this example because it shows in a crystal clear way what an economic model is all about. Why do we even develop economic models? Structural models of the economy, like the new Keynesian model. We do it in order to try to make sense or interpret what we see in the data, right? If I just show you guys this data, you see that inflation is rising during the 70s. Why? Why did that happen? You cannot hope to explain why that happens unless you can interpret the data somehow, right? What an economic model does is it's a lens through which we can view or interpret actual macroeconomic data. And the new Keynesian model provides a compelling explanation for what happened through the 70s and in the 80s. The Fed did not know what they were doing in the 70s. They did not raise the nominal rate, the federal funds rate, enough to stabilize inflation. They figured things out during the 1980s, and inflation has been able to come down and become much more stable ever since then. And I'm not just picking on the Fed. Many central banks across the developed world experienced the great inflation as well. And a lot of their data also indicates that real interest rates were falling at the time. Okay, you guys have any questions then about that? So, what have we talked about so far? We've derived the new Keynesian model. The supply side is characterized by a Phillips curve, which comes from this underlying story of monopolistically competitive firms and sticky prices. The ISMP side of the model, that is the demand side of the model, comes from two things: an intermediate micro type downward sloping IS equation and a monetary policy rule, in particular the Taylor rule, right? That's probably the most useful one to think about. Together, those two concepts, the Phillips curve and the ISMP curve, jointly determine the levels of the output gap and inflation in equilibrium. We used that ISMP Phillips curve model, or the new Keynesian model, the three-equation new Keynesian model, to understand how the economy responds over the course of the business cycle to changes in a lot of different things, like demand shocks, like supply shocks, like changes in inflation expectations, like changes in the inflation target. And a key feature of that model is that the reason why the variables change by the amounts they do is because the central bank is following this monetary policy rule, where it was assumed that the coefficient on inflation was bigger than 1. That is, that the model satisfies the Taylor principle. But we also use the model to try to understand what can happen, what can go haywire if the Taylor principle is violated, right? And we saw that that probably did happen in the 1970s. The last thing that I want to discuss that will take me through the end of the next class is this concept called the zero lower bound. Okay, let's just state some facts first before I discuss fully the motivation. So between September of 2007 and December of 2008, so that year before the financial crisis and during the first couple of months of the financial crisis, the FOMC lowered its target for the federal funds rate 10 times in a row. 10 times in a row. It lowered it from 5.25% all the way down to a target range of 0 to 0.25%. Okay? At the time, this marked the first time since the Great Depression that the nominal federal funds rate had essentially hit 0. Okay? Now, it turns out that in April of this year, as a result of the Fed's policy response to, I don't know what it will be called, I guess the pandemic recession or the COVID recession, The FOMC again lowered its target range down to 0 to 0.25% from around 2.5% this time. And it lowered it pretty quickly, okay? So what we have seen here in the last two recessions, the Fed has very quickly dropped the nominal policy rate essentially to 0. And in fact, it has kept the policy rate at 0 for quite a long time, even after the recession ended. So in both of the last two recessions, this, what we call zero lower bound on the nominal policy rate, has come into play. Whereas if you look at recessions prior to the Great Recession, the Fed did not encounter this zero lower bound. I think because we live in a low interest rate, low inflation environment now, we better get used to seeing interest rates being very low. And during recessions and even during periods after the recession ends, we also should expect to see long periods of zero nominal policy rates. So it's incumbent on us, monetary theorists, to use our models, or it's incumbent upon us to use monetary models that can accommodate this idea that the interest rate doesn't go below 0, that it doesn't become negative, let's say. Fortunately, we can make those modifications in the new Keynesian model. And that's what I want to start talking about today. And really in the next class, we'll go through the mechanics of exactly how the zero lower bound can create a lot of problems for the central banker in much the same way as violations of the Taylor principle do, okay? Now, just to be clear about the definition here, what do I mean when I say the zero lower bound, or ZLB? That stems from a belief that the nominal interest rate is not going to go below 0 because commercial banks could simply always hold vault cash in lieu of Federal Reserve deposit. So the policy rate can't go below 0, right? Jameson, let's imagine that you are the CEO of a central bank and the Fed announces that the interest rate on reserves, which is very much tied to the federal funds rate, right, in a floor system, is going to be negative 1%. So that means you're going to have to pay the Fed for the privilege of depositing your reserves there overnight. Well, couldn't you simply withdraw your reserves from the Fed and hold them in your own vault as vault cash? You could do that. And the belief that banks would do that if the Fed tried to charge a negative or pay a negative interest rate, that is, charge banks for holding reserves, is this idea that and that's why the interest rates can't go below 0. It's not feasible because banks simply would not participate in Federal Reserve balances at that point, okay? Now, recent experience, however, has shown that there are a variety of what I'll just generally call transactions costs that are significant enough to make these overnight rates with central banks actually go negative. Now, this has not happened in the US, but has happened in Japan and has happened in several European countries. Okay? In other words, 0 is not the real lower bound. That in fact, the Fed could get away with paying a negative interest rate. Now, why might this occur? Well, there are certain costs, Jameson, of holding large quantities of reserves in the form of vault cash, okay? Imagine you had $50 million in reserve balances and you liquidated it from your holdings at the Fed and tried to shovel it into your vault. You're going to start to pay some more costs associated with that. There's going to be storage costs. You're going to need a bigger vault, okay? There's going to be larger insurance costs you're going to have to face, right? If people who might rob the bank know that there's $50 million in there instead of $5 million, you're going to pay more to insure all of that vault cash. But here's the big one, in my opinion: transportation costs. If people swipe a debit card, remember what happens in the bank clearing process, right? The Fed simply debits the reserve account of my bank and credits the reserve account of the merchant's bank, right? Well, what happens if all banks are holding reserves as vault cash? Then you have to physically transport cash from one bank to the next via armored truck. Okay, so there are various transportation costs, insurance costs, and what I'll just generally call storage costs, which actually might be big enough to induce banks to actually pay the Fed for the privilege of depositing reserves with the Fed. Okay, the point remains, however, that there's still going to be an effective lower bound, right? The Fed can't set a negative 100% interest rate, right? Otherwise, banks are going to figure out something else to do. So there is going to be some effective lower bound. Is it negative 0.5 percentage points? Is it negative 1%? We don't really know what that is, okay? But there should be some effective lower bound that's probably a little bit lower than 0, okay? And we're just going to assume moving forward that that effective lower bound is equal to 0% in our new Keynesian model. It makes no difference to the analysis. We can set the lower bound at negative 1%, and we're going to get all the same basic qualitative results. By the way, the 0 lower bound, or the effective lower bound, is one of the main reasons why certain economists, I'm not one of them, and many policymakers would like to get rid of cash altogether and simply transition to a purely electronic form of currency. It's because it would allow central banks to actually implement negative interest rate policy. Okay? Think about it. If there was no cash, if all of our money was just in the form of electronic currency that was on the ledger of the Federal Reserve and all the commercial banks, then even if the Fed wanted to implement a negative interest rate, we can't withdraw cash and store it in some safe, right? Or the banks can't withdraw reserve balances and store them in the vault because there is no cash. So it makes it easier for central banks to actually implement negative interest rate policy instead of just keeping the interest rate pegged at 0. That's one of the big motivations behind trying to eliminate cash altogether, is that this 0 lower bound no longer becomes an actual constraint, right, Levi? Well, what banks would try to do is if the overnight rate at the central bank got so negative, they would lower their reserve all the way to the minimum required and simply try to deposit those reserves elsewhere that's at least earning a 0% interest or some other asset, right? Now, other short-term assets might also have negative rates. We don't know, but I think banks would probably take on more risk to try to avoid paying that. There's other reasons why people want to get rid of cash. So I think in the euro area, they either have already gotten rid of the 500 euro note, or there are plans. So in the euro area, there's not just a 100, so we have the $100 bill, but the $500 bill is not in circulation. No one uses that, right? In the euro area, I believe that for a while, the 500 euro note was in circulation, and that enabled banks to avoid some of these big storage costs, right? Storing 1,500,000 euros notes is a lot easier than storing the same quantity of 100 euro notes, right? The space is smaller, and so I think the plan was to get rid of the 500 euro note in order to make these storage and transportation costs bigger, right? That way they could try to lower policy rates below 0. There are also plans. There have been policy discussions about getting rid of the $100 bill for that very reason, right? If the next highest bill is $50, it makes holding large quantities of cash that much more costly. So this is what I'll finish with today, and we'll save the actual analysis of the zero lower bound in the new Keynesian model to the next class. Here is a graph that shows 4 variables, okay? The purple line is real GDP, and it's measured over here on the right axis, okay? And it's from 2007 to the present, okay? The 3 lines up here at the top, the blue line, the red line, and the green line, the blue line is the effective federal funds rate, and then we have the 1-month Treasury bill rate along with the 3-month Treasury bill rate. So 2 other short-term nominal interest rates that aren't controlled directly by the Fed, but are heavily influenced by the Fed's decisions about the federal funds rate, okay? Now, just a little bit of background here. Starting in 2008, when the financial crisis heated up and it was clear that the economy was heading into a recession, you will see that real GDP declined in 5 of the next 6 quarters. In fact, real GDP by the end of 2009 was like 4% lower than what real GDP was at the start of the recession. So this was a significant decline in economic activity, all right? As a result of that big reduction in GDP, the Fed dramatically lowered its policy rate from around 5.25% all the way to its target range of 0 to 0.25%. That is the zero lower bound. These other short-term market interest rates fell correspondingly, right? And you'll notice here that the Fed kept short-term rates at 0 all the way until late 2015, at which the economy recovered enough to try to renormalize policy rates. It got all the way to around 2.5% before the economy started to deteriorate some, and it lowered the funds rate down to around 1.5%. And then, of course, the pandemic hit. We had this huge drop off in real GDP. It's a massive drop off because we shut down the economy. And as a result, the FOMC decided to immediately lower short-term rates, again, all the way back down to 0. So we see that crystal clear that in the past 2 recessions, the Fed is lowering the funds rate all the way to 0, okay? And it's also clear that if the 0 lower bound did not exist, the Fed would probably like to go below 0, right? And that's one of the reasons why it was pegged at 0 for so long after the recession even ended. Expect to see that as well. Whenever the pandemic recession officially ends, I promise you that this interest rate on the federal funds rate is going to stay fixed between 0 and 0.25% for quite some time. So the 0 lower bound is a real thing, right? It's something that we have to account for, that we have to incorporate into our models to try to understand the transmission mechanism or what the implications of the 0 bound are for the transmission mechanism. We used to not have to do that. When this course was taught before the financial crisis, we could ignore the possibility of the 0 lower bound. Now, it should be a fundamental part of our model. And so what we're going to do in the next class is show specifically how to augment or modify the new Keynesian model to account for the 0 lower bound. Obviously, there's going to be a change to the monetary policy rule, right? The monetary policy rule is no longer going to look just like a regular old Taylor rule. It's going to, the policy rule is going to call for the nominal rate to be equal to 0 under certain conditions. If the policy rate can possibly be 0 under certain conditions, that's going to affect the shape and structure of the ISMP equation. It's going to look really bizarre, okay? The Phillips curve probably shouldn't be affected, but because the ISMP curve shape is going to be affected by the 0 lower bound, anytime we have these demand or supply shocks, it can cause the equilibrium to move in places that are a lot different from what we've analyzed before. And the kind of the punchline from this is hopefully I'll be able to show you this by the end of the next class, is that the zero lower bound causes, in certain circumstances, the policy adjustment to kind of mimic what happens when the Taylor principle is violated. And when the Taylor principle is violated, what do we see happen? That you get these unstable inflation dynamics, okay? Except in this case, during a recession, when GDP is falling and inflation is falling, instead of having unstable inflation, you can have unstable disinflation or even deflation. So trying to avoid this kind of deflationary spiral is very difficult to do because of the zero lower bound. That's really why the Fed implemented these unconventional policy measures like QE and forward guidance and all of these large-scale asset purchases during the financial crisis, is because it had run out of room using conventional monetary policy. The Fed funds rate hit zero, they couldn't lower it anymore. All right, and so to try to prevent that deflationary spiral from happening, they had to resort to these other tricks in the bag, okay? But we're going to examine analytically in the next class how the zero lower bound, or the implications of the zero lower bound, in the context of the new Keynesian model. And that will be the final thing we'll do. We'll do a couple of example exercises like we've done before. And then you guys will have a lab, I believe, next Monday. That lab will cover 3 topics: exchange rates in the central bank, monetary policy goals and rules, so the dual mandate, the Taylor rule, rules versus discretion, a loss function for the central bank. We worked through some of those examples together. And then also the new Keynesian model in its entirety. And then I guess you guys will have an exam on the very next Wednesday that will cover the same 3 topics. I'll do my best to kind of get you guys to that point and give you enough practice and example problems through the lab to get ready for that, okay? All right, if there's no other questions, we'll stop for today.